Forex and capital markets were rattled yesterday, leaving the private sector confused and concerned, after the central bank unofficially pegged the rupee to the dollar at a fixed rate. The fixed rate of the dollar and reasons for the move were conveyed by Central Bank Governor Professor W.D. Laxman to all bank CEOs in writing. As responsible members of the financial community of this country, I most categorically require and request your active and tangible cooperation in order to ensure that the exchange rates is maintained at the formally agreed rate range of 200 rupees to 203 per dollar and, correspondingly, to ensure that the rate does not deteriorate beyond this agreed rate range, said the CB governor in his letter. He also categorically told banks to comply and cooperate in the greater national interest while efforts are underway to boost foreign inflows. Prior to yesterday's move, the US dollar was quoted by banks between a low of 225 rupees and a high of 235 rupees. This was despite the central bank repeatedly communicating that the indicative rate was 203 rupees. In the black market, dollars were expensive between 240 rupees to 250. The forex market was largely inactive as importers and traders found dollars unavailable at the lower rate, with banks not keen to open LCs. The move is helpful for importers provided dollars are in adequate supply, while experts opined importers would now have to wait painfully longer for their requirement. Investors in the Colombo stock market also had concerns since recent bull run was on the premise that reserves crisis meant greater attractiveness for listed companies which have significant dollar earnings. Market dipped partly because of this as well as profit-taking following all-time high share prices until last week. For foreign investors, an appreciation of the rupee should be good news, though the CSE has seen net foreign outflow racing to over 41 billion rupees year to date on top of 50 billion rupees last year. The CB action also sent shockwaves within the export community, which was hoping for a realistic official rate. With a fixed rate expected to last till end December, exporters will now be forced to convert their earnings rather than delaying on speculation of further depreciation. After 25% mandatory conversion, exporters were holding on to cash in tandem with speculator high rates. Some feared mandatory conversion might be increased to a higher percentage if the situation warrants post yesterday's CB move. Exports were up 29% to $5.7 billion in the first half of this year, and original target was around $12 billion. Imports, on the other hand, jumped by 30% to $10 billion despite restrictions. Among benefits are the value of the country's debt stock coming down overnight and imports being cheaper, and import cost push inflation, reducing thereby the cost of living. On the other hand, the central bank will need more dollars to defend the rate at this predetermined level. Markets are also awaiting reactions from rating agencies and global investment banks on Sri Lanka's latest currency move. Analysts said for several weeks that the economy couldn't sustain the 2- or 3-tiered forex market, with the central bank maintaining one rate, banks quoting another, and black market a different rate. Some labeled yesterday's central bank action as a moral suasion, and questioned whether the foreign banks which are active in international trade financing will toe central bank's line. Some foreign continued to quote higher rates yesterday than those directed by the central bank.